to this computer. Recording in progress. Okay, that's good. I share my screen again. Okay, so I put it in a presentation mode. Okay, all right. So we're welcome to this seminar on introduction to investment. And as we go along, if you have any questions, you can jump in. Try and finish everything before 6 o'clock. So an important notice, financial information, especially in the UK, is actually regulated by the Financial Conduct Authority. So anyone that gives financial advice, there must be have like a license and must be regulated um, by the FCA, which is the Financial Conduct Authority. So just putting this out that this workshop is just for educational purposes only. So it's not does not constitute any form of financial advice or guarantee the results that we get. So it's important that as individuals, we also like carry out our own due diligence as we go along. Now, what are we going to cover in this workshop? What is investment? Why do we need to invest? How do we invest? What are some of the pitfalls and challenges that we may face along our investment journey? And how do we avoid them? And yeah, Bible says in everything, wisdom is the principal thing. In everything, get wisdom. So that's what that one is about. Just some other areas where you can go for additional information. So what's the difference between saving and investment? So savings involves, putting aside money for a short to medium term financial goal. So let's say someone is saving, like a deposit to buy a house, you're saving, to maybe to buy a car, putting money into like a savings account, that kind of thing. That's what we refer to as savings. But it's not the same thing as investment. Investment, on the other hand, is it's like a medium to long term horizon. So and it's very different from saving, which is a short term. And investment also carries a higher risk, you know, compared to savings. So the interest that someone gets from a savings account, is usually much lower than the return that people get from investment. But then the flip side then also applies in the sense that the risk that comes with investment is higher than the associated risk that comes with savings. So risk and reward, um, that's the name of the game. So the higher the return, the higher the risk. And what do you define risk to be? Risk is that what's the probability of somebody losing their money, losing some of their money that they invested or all of their money. That's what risk means in terms of financial investment. Uh, so and then, like I said, you just have a longer term horizon, and then it will help us so that in case of as your on your investment journey, as the maybe the value of investment maybe it goes down and things like that, you don't just carry out some knee-jerk reactions. Someone just be panicking, and that's where a lot of people lose money because they just panic. It's gone down by 2% or 5%, and then they quickly want to sell. Whereas maybe over time the thing will then recover and go on to be maybe and compound to be like maybe 20% over time. So we usually encourage people that it's a longer term thing, have a 5 year view and even longer, and may help your money to compound as we go over time. So, like I said, savings involves low risk and low return. Investment is higher risk and higher return. And this is very important. There is nothing like a low risk, high return business or investment. That's a scam. That's why a lot of people get scammed. So, this business, don't worry, the risk is very, very, very low, little or no. But you get a lot, you get high return, you get 100% return in 3 months and things like that. That's where things like Ponzi scheme comes in, all those kind of scams. So if you say something is very, very low risk and the money you're going to get back is very under a very short time, you're going to get a lot of money back. You have to be very, very wary of such things. So there's nothing like low risk, high return. You know, it doesn't exist. Most of the times they are scams. So we need to be careful about such things. But why do we need to invest? We need to invest because it helps us to build wealth passively. What do we mean by that? That means when you're investing, you are sending your money to work on your behalf. And the money is working on your behalf, you know, day in, day out. Whether you're asleep, you're on the road, things like that. And it's different from, getting money actively, in the sense that, for example, most people are employed. So your income is tied to the fact that you need to show up for work, you need to go to work, you need to do that business, you need to do that thing, you need to be actively involved in it. Whereas when it comes to like investment, your money working passively, you're not actively doing things. You've sent it to work and it's working on your behalf. And that's very, very important. So, I would also go to say that, excuse me, that investment is different from trading. I'm not covering trading here. Trading is where people are actively involved, in the financial markets. So they could be trading shares, they could be trading gold, commodities, all the other things, currency, whatever it is. And almost every day or every hour, they are sitting down on their computer and looking, okay, time to buy, time to sell, and things like that. That's not what we are talking about here. That's not the approach we are taking here in terms of investing. So it help with investment in a short, just like it's a way in which to build wealth passively. Savings that we put in a money that we put in a cash in a savings account, it loses value and buying power over time because of inflation. So you may have heard some of the phrases, like, for example, the RPI, Retail Price Index, or CPI, Consumer Price Index. So these are just different ways in which inflation is being calculated. And inflation, in a very simplistic term, is the degradation of the value of your money over time. So over time, the value of money, degrades. So the purchasing power of money over time, it gets less and less. So that's why we hear phrases like, I remember, when years back, where a car cost £3,000. Now a car costs, an average car, new car costs 30,000. That's a result of inflation. So over time, things get more expensive. So the same amount of money that you have in the future, by the end of the year, by the end of 2 years, it cannot purchase what you used to purchase before. And in different countries, depending on how well the economy is being managed, the rate of inflation is different. So, for example, now the latest inflation figures in the United Kingdom is 3.5%. So that means things are getting 3.5% more expensive compared to last year. And the CPI that they use, the Consumer Price Index, is just they look at the basic goods and services that people use, and then they calculate that over the period of the past year, how has things increased or decreased. So because of inflation is almost like gravity. It's not like constant. It is constant, but the figure fluctuates. But it's one of the things that degrades the value of money over time. So again, let me just give us like a real example. In the 70s, 1970s, the average price of a house in London was £5,000. £5,000. Now, the average price of a house in London is maybe about 500,000. So imagine now if maybe somebody's grandparents or father, maybe they kept £5,000 in a safe. Say, oh, I'm going to keep this one in a safe in 1970 for my child, so that by the time he's old enough, I'll give him that money to buy a house. Over time, that 5,000, the value of that 5,000 cannot even buy. I don't. It's not even enough for a deposit. But £5,000 in 1970 could buy a whole house in London. Why? That is inflation. Inflation that's at work. Inflation both in the economy and then inflation in the property market. So let's go very quickly. So investing helps us at the very least to keep to pace with inflation, or more importantly, want to actually beat inflation so that you actually build wealth. So it's not that somebody is running on a financial treadmill. Every day you are going out to work, but at the end of the year, you are looking, I don't have anything to show for it. Those kind of things. Investing will help us to keep a pace with inflation or even beat inflation so that we can help to build wealth. Now, why do we need to invest? There are also tax advantages that comes into investing. We're going to go through these acronyms that we have there. But very quickly, the first one has to do with pensions. It is a savings, self-investment pension plan. That's what SIP means. ISA, is an individual savings account. LISA is lifetime individual savings account. VISA is junior ISA. I'm going to explain this further on what they actually mean. But they have tax advantages that come with them. So, for example, for the SIP, for every £80 that a UK resident, puts into their private pension, the government will top it up with 20%, £20. So you get mostly like getting 20% free money for money that you put in, that you invest into your own individual pension plan. And then ISA, the thing that's good about ISA is that, you know, it is the income that you get from an ISA. It is free from income tax. It is free from capital gains tax, so it can grow and accumulate over time. So there are tax efficiencies, advantages that, especially from the people who are resident in the UK, that's available for us to invest. And why do you need to invest? For financial independence, to leave a legacy for the children. It could be for the church or the charity, or to impact other people. So we need to look at, investing is not just for me. It's that to help me to live a financially more secure future, but also be able to impact others as well. Why do we need to invest? Now, this is a chart that I want to show, just go through very quickly. So it's a chart that shows the investment return on the S&P 500. S&P 500 means the Standard and Poor um, index. It's the top 500 companies quoted on the US stock exchange. So over the period of 40 years, or even if you go back to maybe like as far back as the 1929, and there was like a great crash, it has averaged a return of 10% per year over the past 40 years. Now, as you can see in the chart, you know, um, you can see in the chart, I'm looking for my mouse. You can see that, it goes up, then sometimes it comes down. It goes up, it goes down. So it's not like every year it's just going up straight. Sometimes it goes down, sometimes it goes up, sometimes it goes down. This one that I have in gray here, it was during the 2008, crash, the great financial crash. You can see there that, the S&P dropped. I think it dropped about 40% or thereabouts. But then you then see that it recovered over time, going up and up. So the trend over time is up, but doesn't mean that it's going to be straight. So if somebody, sold at this point in time, sold when it hears it's crashing, maybe to go to the zero, that means they will miss out when the thing comes up again. So on average, I'm going to talk about, what you need to invest in, how you go about it. Start small, build your confidence, get more information, and then build it. But the most important thing is that someone starts. So why do you need to invest that? You can get like a 10% return on average, for example, on the S&P 500. That's almost like it's being used like an investment benchmark for investment returns. So if somebody comes to you with an opportunity, say, this business opportunity, come and invest in my business or whatever, and you're going to get like 5% return. I'll give you 5%. You can then use, is it really going to be a good deal? Because I can also invest in the S&P 500. Yeah, there's a level of risk with it, but over time, I'll get 10% on average. So it's being just used like a very rough guide in terms of, okay, how good is an investment, how risky it is, and things like that. So why do we need to invest? So I'm going to give this scenario, because also in addition to that, there's also the part of compound interest. There's this quote that is attributed to Albert Einstein. He says that compound interest. I think he said maybe compound interest is the did you say is the eighth wonder of the world? So I understand what compound interest is. That how the money that you invest can compound over time. And this scenario that I'm going to paint for us, will give you an idea of what it is. So like we saw in the previous slide, the S&P 500 gives like an average return of 10% over time. This example that I'm giving, with just reducing the return a little bit from 10% to 8%. So the scenario is, that a couple, they have a child. Let's call the child Alex, and then they began to invest £200 per month in an index tracker that returned 8% for that boy. Yeah. So after 10 years, they stopped. Yeah. So they only invested for 10 years. So £200 per month for 10 years, and then they stopped. So when the boy was 10 years, they stopped. They just kept the money there. and money kept on, just growing at 8% a year. Yeah. So after year 10, the money has grown to 37,333, and then leave it to compound for the next 10 years. So when he's 20, maybe it's like almost finishing university, it has compounded to 82,199. Again, he then left it. He said, this money is growing. Let me leave it. So Alex left it for another 10 years. So when Alex is age 30, that money has compounded to 182,452. Remember that his parents only invested how much? 200 pounds times 12 is 2,400 over 10 years. They only invested 24,000 over a 10-year period, and that has grown, over compounding at 8% to 182,000 after 30 years. So you can then see the power of compounding. Now you can then imagine if over that time he was also adding money, how much that thing will have grown. So compounding, giving it time and compounding, those two are very, very powerful things when it comes to investing. So like I said, investment is a long-term view, at least 5 years. It's different from short-term, which is saving. Why do you need to invest? So this is like a brochure of the Church of England. So the Church of England, they have a fund. It's called the Church of England Investment Report. So they have a fund that they invest in, and over time, this was as far back as in 2022, it has grown to 10.2 billion. So the Church of England, they have like an investment fund. It has grown to 10.2 billion. They invest in different things, forestry, shares, properties, different things. So they invest. So they're not just taking the money and putting in the savings account. And again, just to talk about the savings account thing, I looked at my savings account or my savings account. The interest they are paying is 1%. Inflation is 3%. So the value of my money in that savings account, I'm losing money in real terms because what? The value of the money is degrading faster than the interest that I'm getting. So that's why it is good for us, at any level. And I'm going to show us how to, as much as possible, start investing. We can start small. But let's get our feet in. And as we begin to understand things better, we can increase. Why do you need to invest? I think I've gone over this. I hope we are convinced that every one of us should start investing. So, like I have here, we can start small, start taking baby steps. Also, how do you invest? You invest in yourself, read books about financial investment, listen to podcasts, do your own research. You can research investment platforms and apps that you can use for investment. I'm going to show us some of them. And then some of these investment platforms, you can start for as small as 25 pounds a month. So it doesn't have to be that until you have a loss and loss and loss of money. And especially for people who are starting out, and for most people, even some of the most accomplished investors in the world, for someone like Warren Buffett, he almost like touts that most people should invest, most individual investors should actually invest in tracker funds. I'm going to talk a little bit about what those tracker funds are, rather than investing in individual stocks and shares, which can be very volatile. Now, especially now that we have things like AI, software, algorithm trading, they can swing very quickly even before you bring out your phone and things like that. But trackers will give you a little bit more protection, because instead of investing in an individual stock, you are investing in a basket of stocks. Like for example, the S&P 500 that tracks the top 500 listed companies in the United States, as an example. We'll go over what some of these mutual funds or index funds could be. So how do we invest? You need to decide what you want to invest in. Are you investing in an ISA? That's an individual savings account. Or is it a SIP? That's a private pension. Or is it a LISA? A LISA is really targeted for those that are aged 18 to 39, where government, tops up 25%. Again, help trying to encourage young people, to save, either for as a deposit for a house or for their pension. Or is it a junior ISA? You want to invest, for your children. So you want to decide what you want to invest in. I mean, you can do maybe like 3 of them. depending on your age and things like that. But I would suggest maybe just start with one, get used to that, and then you can then go to the other ones. And then decide which platform you're going to use. Open an investment account, choose your funds. Like I said, you can start with as small as £25 per month. There are even other platforms, especially some apps, which I will point us to, and you can also Google and check as well. Like I said, do your own research. That for as small as maybe like £1, you can start investing. Of course, that may not going to do a lot of make a lot of difference. But what it's doing is that you are not getting involved in the financial market. You are getting used to how things are working, and then you can start increasing the amount as you go along. So the most important thing is that once we have this information, we need to take the action as soon as possible and not to wait too long. How to invest? Like I said, decide what you want to invest in. So I'm going to explain a little bit more what these things, what the ISA is, what the SIP is. So like I said, the ISA is the individual savings account, and then well, of course, open to people who are resident in the UK, and then you can invest up to £20,000 per every tax year. And your ISA is exempt from capital gains tax and income tax. So capital gains tax is like let's say you buy a shares or you buy an index fund for let's say £5, and then it increases to let's say £20. Your gain there is £15. Yeah, you won't pay any tax on that gain and any other gains that you have. So far, it is part of the ISA. Yeah, so you don't pay any tax. So because the government is trying to use it, to make sure to encourage people not to invest in capital markets. So that's what an ISA is. So you decide what you want to invest in. Then let's look at the SIP. The SIP, like I said, stands for the Self Investment Personal Pension. So this could be like an additional in addition to your work pension. So maybe you're working, your employer pays some pension for you, but you want to like, let me try and beef up my own pension as well. So that's what a SIP, is there to do. Or if people are self-employed, so they don't really have a pension, they're encouraged to open up a SIP, self-investment personal pension. And then, like I mentioned before, the government adds 20% to your SIP contribution. So every contribution that you make, you get, 20% from the government. It's free money. You may be asking, why is government giving people free money? Why? Because they want to encourage people to invest, and they know that the more people invest in their pensions, then the less there will be burden on the government when they get to retirement stage age. Because maybe over time they've built enough in their pension pots to be able to take care of themselves, so they will less dependent on the state. So what other things do we need to look at? What are you investing in? Like a junior ISA. Again, that's an ISA for children from ages 0 to 18.
If I, what you are doing
So
now, can you not do it later?
sorry, can you go on mute?
It's
We are recording.
costing me, Daniel.
So you can invest up to 9,000 for each tax year, and it's free from income tax and capital gains tax. That's what a junior ISA is. A lifetime ISA is you can save for your first home or for your retirement. And like I said, like a LISA is open to those who are aged 18 to 39. And then the government then gives them they can save up to 4,000, a year, every tax year. And the government can give them up to £1,000. So they get like 25%, from the government, free money. That's what a LISA is. But people don't look at it because the rule sometimes changes from time to time. But that's what the LISA is. And that's £4,000 that forms part of your LISA, is part of your overall £20,000, your annual ISA allowance per tax year. So decide what platform you want to use. There are different platforms that you can use. So you can just go on Google and say, oh, the best investment platform, financial investment platforms. Go on, Money Supermarket Expert. There are different places that can compare and give you, But these are some of the ones I just want to highlight. There's Hargreaves Lansdown. I think that's the largest investment platform in the United Kingdom. There's AJ Bell. You may have seen some of their adverts. Vanguard, Plum is an app. Moneybox is an app. Fidelity is another big fund manager. You just Google it, and I just put a link there as well. It just gives you. It helps to compare the different platforms. I mean, to be honest with you, there's very little in between them. The one that I use personally is not a recommendation. It's just that, that's the one that I use. The one I was introduced to is Hagrid's Lansdowne. But, you can check other ones as well and come to your own conclusion which one you want to use. So when starting, what do you invest in? Because we've talked about, okay, what you've decided. Do I want to go start with an ISA, or is it going to be a SIP, depending on your circumstance and your priorities? Then, then you want to choose your platform, which platform you're going to use, the avenue through which you're going to invest. So what do you invest in? When you're starting out, we need to keep things very, very simple. Let's keep things very, very simple. So like I said, we invest in a tracker fund or a mutual fund. Mutual fund is usually an American term. A tracker fund, index tracker is what we usually use in the United Kingdom instead of individual stocks. And I'm going to give us some examples of what those index funds are. Now, why, like I said, that individual stocks needs a lot of thoughts, a lot of analysis. It could be fundamental, what they refer to as fundamental analysis. You look at, the price to earning ratio of the stock. You look at the sector in which the stock is. You look at the yearly returns. You look at what is the revenue, what is the valuation of the company. A lot of things to take into consideration, which people who are like maybe experts, that's what they do from day to day. So it's usually advisable when people are starting out to uh, expose yourself instead when you're investing through tracker funds rather than individual stock. There are some that you can invest in, they go to the moon, but also they can drop down to zero. But if you invest in a tracker fund, which tracks like a basket of funds. So if, for example, I invest in let's go through very quickly. So there are some of the different ones. There are loads and loads. There are hundreds, if not even thousands of funds, tracker funds, index funds that you can invest in. The S&P 500 is the top 500 companies in the United States. The FTSE 100, you may have heard about that. That's the top 100 companies that are listed on the UK stock market. The Nasdaq 100, they are the top 100 tech companies listed in the US. FTSE 250 are the top 250 companies listed in the UK stock market. So it includes both the 100, both the FTSE 100 and the additional 150. It includes, like maybe like mid capital companies. The Dow Jones, those are the top 30 industrial companies in the US. That's US, not UK. So the Dow Jones 30 is listed in the UK, in the US rather. The FTSE 350, the top 350 companies that are in the UK. Or you can even track funds that like the MCI World Index. So it tracks about 1,300 large and mid-cap stocks across 23 developed countries. So like I said, when you invest in a tracker fund, what it does is that, let's say, for example, you invest in the FTSE 100. Let's say I invest £100 or however much you are now, you invest. What the fund does is that it takes your money and distributes it and buys a little bit of shares in all of those companies that are listed in that index. So there's more diversity, there's more protection. So it's very, very unlikely that the whole FTSE 100, for example, will go to zero. But if I put that same £100, I buy an individual stock, maybe like Barclays or Shares or Shell or whatever one that's listed on the UK, it's very possible that they can go to zero, or they can reduce, or whatever happens to it. There are some classic cases of a company like Enron and things like that. They were the darling of the stock market, but they were doing some financial manipulation and things like that, and they went to zero, gone. People's money are totally gone. But something like that is very, very unlikely that the whole stock market will go to zero. So when people are starting out, let's keep things very, very simple. And then when you're picking your index funds, you're given two options in terms of the dividends. So the dividend that comes for it, they'll ask you, no, you have two options. Do you want to invest in a fund that distributes your dividends? So the dividend that you receive, do you want to receive it as cash paid into you, or do you want to invest in a fund which has like ACC? That's like an accumulated fund. The accumulated fund means that they reinvest your dividends so that it can compound over time. And the example that I showed us, about compounding. So I usually, encourage people that when you invest in an index tracker fund, choose the one that has the ACC. You see there, I'll show you one or two of them. It's accumulating so that the money can compound over time. So what you invest in, again, take action. Don't procrastinate. Don't do analysis paralysis. Remember, like I said, you can start small. So, I mean, if you start investing, for example, £25 per month, that's like the price of a pizza. Some people treat themselves every Friday. Thank God it's Friday, and then they, do takeaway or whatever. Can you reduce your 4 takeaways in a month to two? So you release some money, to just start investing. And like I said, there are some apps that can even invest for even smaller amounts, £1 or whatever, like Plum or maybe Moneybox or some other ones that you can research them out. Again, you're getting your foot, dipping your toe in the water, getting used to investing. And, it's not like, hopefully you're not putting large amounts. And it's also something I want to point out is that even if you have like a large amount, let's say you have 10,000 that you want to invest or 1,000, it's always good for you to, they call it cost dollar average. So that means you invest a little over time. So let's say I have £1,000 to invest. I say I'm ready to go. I'm ready to go. I've done my research. I know what I want to invest in. I've chosen my platform. I want to invest this 1,000. It may be good for you just to spread that over time. So make that 1,000, maybe just invest £100 each month, gradually like that. So the idea is that you are gradually getting used, and over time you are then building rather than if I put the whole 10,000 or the whole 1,000. If the market drops, by let's say 5%, your heart can go up. But if you set aside that 1,000, you put aside, you just invest 100 this month, and then you watch as things go. Then next month like that, and then things can, average out over time. So start small and build from there. This is just the link again for us to compare the different investment platforms. So what are some of the pitfalls in investment and how can we avoid them? Not doing your own research or not investing in yourself, not having investment goals, reacting emotionally. Like I said, it's like you're watching every time and then you're listening to financial news or whatever, and they say, it has dropped, and then you quickly want to move out, and then you lose out on the compounding. Remember what I said about the S&P 500 as an example. Even going back as far as 1929, it has averaged a 10% return over time. But the 10% return is not like a straight line. Over time, sometimes to go down, sometimes you go sideways, sometimes but most of the time when you average it over time, you have a 10% return. So it's good that you stay in the game and don't react emotionally. What do we mean by reacting emotionally? You quickly sell when the market falls. You sell your investment when things are falling. You are not diversified in your portfolio. Again, when you invest in a tracker fund, you don't have this risk, or you mitigate this risk to a large extent because you are buying a basket of companies. You're not just buying just one individual stock. You can start going to individual stocks when you are now a bit more, you have some more information, you are more comfortable about investing, the risks and the rewards and you're comfortable with that. You know what your risk tolerance is. You can start investigating and researching. And okay, I want to buy this particular sector. I want to buy this stock in a particular sector for these reasons. But when we're starting out, it's usually advisable to invest, in tracker funds, not understanding what your risk tolerance is. You know what your risk tolerance is, and settle all those things before you start investing. But again, as I said, if you're starting small, hopefully you'll be able to help you to adjust in terms of, okay, um, understanding what your risk tolerance is and not getting too emotional if things don't go your way, maybe in a short period of time. Like I said, only looking at the short-term returns. Again, like I said, investment is like long term, 5 years, 7 years, that kind of thing. That's kind of horizon that you'll be looking at. So that in the short term, when they are like dips or the market is going sideways, maybe going up or it's not really going up or going down a little bit and coming up. You are not, emotionally, because you're having emotionally carried away because you are looking at a 5 to 7 year or even longer term view. You're not paying attention to the fees without true what the fees are, not building financial resilience. This one is more about the fact that before you start investing, it's really advisable that you have like an emergency fund. Definition of emergency fund can vary. Some people can say, oh, you need to have like 3 months of your salary, saved that you can easily access, in case you need like an emergency, up to 6 months. Some people can maybe say 12 months. As a bare minimum, it's good to have maybe some money aside in case, some things, break down at home, or that you need to have money to address, rather than the investment that you put. You now have to liquidate that to attend to an emergency. So for me, the basic amount for an emergency fund, really, I would say we should have at least maybe like £1,000 just set aside, put in a savings account. It's not generating much, but you can easily access it in case you want to address to something. For example, the last time I took my car for MOT, they said two of the tires needs to be changed, and each one was about £120. So you need to have like an emergency fund to address such things. So I would say, 500, 1,000, ideally £1,000. Just put that aside to be able to address things. And also, as advisable as much as possible, try and pay off your debt. Because, for example, credit cards, credit card, they charge interest maybe like £20, 20%, some 25, 40, depending on what somebody's credit rating is. So you'll be generating more interest on your credit cards or those kind of debts. So it makes sense for you to try and pay them down or pay them off before you start investing. But some people can say, oh yes, I want to pay down my debts, but I said I want to start investing as well. Like we go back again to £25 a month or whatever, or less than that. Let's start, getting educated, um, and just budget. So if people have not used to budgeting, I can have a different, session where to go through budgeting, which is really, really helpful. This what I have here is just to give us an idea of the different risk and return profile of different, investment, um, uh, different investment, just funds, not funds, um, things that you can invest in. So if you start at the bottom of the pyramid, like the ISA, like I said, index funds, you can have up to 10% per year return, sometimes even more than that. It is low risk. It's not that there's no risk to it, but it is low. It is low risk. And then when you go up a little bit, like like the SIP, or some other SIP can also have a slightly is almost like the same level of risk on return compared to an ISA. But by the time you start going to the medium risk, which is the medium risk level, which are the middle of the slide, you can see there things like when you're buying individual shares. So you can have a big return on it. So, for example, maybe some people want to invest in Tesla, Nvidia, and things like that. You're now investing in individual stocks. You can have good return on them, but at the same time, too, the flip side of it is that the money can go down, and you can lose half of it, you can use all of it, and things like that. Then, like I mentioned as well, again, you can then have even much and higher return when you do daily action or like trading. You are in and out of the market and things like that. But it's always good for us to start at the bottom of the pyramid, make sure we are comfortable with the idea of the financial market and things like that before you start going and trying other things like a Bitcoin, all those kind of stuff. Um, it's always good for you to, like I said, start with the index funds, and then if you say, oh, this Bitcoin thing or these other things that are coming up, just set aside. That's what called capital asset allocation. So let's say I have 10,000 to invest. I can just say, oh, I just want to put maybe 5% of that into alternative investment. So that would be like maybe £500. So you are still in that, you're having a stake in that game, but you are not exposing yourself to things that are very, very volatile. Yes, they could go to the moon from zero to 100,000. There are a few months back, Bitcoin was like 120,000. People were saying it's going to get to 500,000. Now it's about 63,000. It's very, very volatile. I know somebody that had like 10,000, put it in cryptocurrency. At that time, the thing was riding. I was looking at this guy. He said he didn't tell his wife in cryptocurrency. Now the thing's like halved. Doesn't mean that, maybe who knows, that the next few months maybe may go back up again, but it's very, very volatile. So what we are saying is that try and have some asset allocation, even if you want to play those games. But let's start with the basic. Let's try and crawl before we start running. So invest in your financial literacy. This is the end. You can ask questions after that, and these are some links that are good for us to go through. Now, I did say that I'm going to share with us how we're doing for time. I'm going to finish now because we have another meeting. Well, I'm going to show us very quickly in terms of, I mentioned some of the platforms here. So this Agris Lansdowne, that's Vanguard, that's which one is that one? That's Fidelity, that's AJ Bell. Now, I said that what you can invest in. This is what I was talking about. So this is a tracker fund. It tracks the S&P 500 index. As you can see, there is a class C, but the important thing I'm talking about here is the accumulation. And then the currency, it's you're going to invest it in pounds. It's good that you also make sure that the fund that you pick is in pounds, not in dollars or any other, because if it's in dollars, then you have to then also deal with currency fluctuation. So it's important that the fund that you choose, let's say, for example, you want to invest in like an S&P 500 index that tracks the whole 500 top 500 companies in the US. Choose the one that is an accumulation so that they can reinvest your dividends and make sure that it's a GP. It's denominated in pounds. So that's one. What else? There was something else that I wanted to share with us. If you do decide, no, I just want to invest in a fund that tracks the FTSE 100. Again, this is one that you can choose. So you can see there, it has the FTSE 100 index. It's provided by Vanguard. It's an accumulation fund, and then it's also denominated in pounds. And then, like I mentioned something about the charges. So this gives you an idea of how much they will charge. Say the initial charge is 0, and then if you are buying or if you are selling it, they will charge you, 1 pound and 95 pence. Now, this shows you the performance of it over the past 4 to 5 years. So you can see the return. It was 4.23% return between June 21 and June 22, and you can see all the other ones. So far now, the FTSE 100, if you are investing in the whole of those, the whole of the 100 funds, one of the companies that are listed in the FTSE 100, so far between June last year and June this year, it has returned 21.5% or 21.6%. So you can see there that the return is good, much better than if you put your money in a savings account. Like I said, my own is giving me 1%, and inflation is 3.5%. So I'm losing money in that savings thing. And if you have money only in savings accounts, your money, the value of your money over time is going down. So that's one of the reasons why we invest, so that we can keep a place of inflation and we can also grow our wealth over time. And that's what I just wanted to share with us very quickly. I'll stop here, stop sharing. You have any questions? Does anybody have any questions?
Yeah, thank you very much, Pastor Niyi. That's been very